Why is BlackRock quietly positioning in silver excavators while the financial media stays completely silent? Here's what they're not telling you. Silver isn't moving because of retail noise. It's moving because the people who actually need it are fighting for supply. And when margin requirements rise, most assume prices should crash. But in silver, it does the opposite. The supply pipeline tightens, hedging becomes expensive, and producers back off. Meanwhile, excavator equities are lagging, not because they're broken, but because institutions rotate in phases. First, they position quietly. Then, the breakout happens. And by the time the public notices, the move is already violent. So the real question isn't if this breaks. The question is, are you positioned before it does? Welcome to Boring Currency Registry. Now, I know you've been around long enough to see patterns repeat. You've watched markets shift, narratives change, and institutions position ahead of the crowd. So if you value analysis that cuts through the noise and speaks to experience, not hype, do me a favor, hit that subscribe button, not for the algorithm, but because you recognize substance when you see it. And while you're here, drop a comment and let me know, where in the world are you watching this from? Are you in New York, London, Mumbai, Karachi, Tokyo? I want to know who's paying attention and where the smart money is tuning in from. Now, let's get into what BlackRock sees that most investors are completely missing. Or there's a story unfolding in the silver market that most investors are not seeing, and it's not the story the headlines want them to believe. The narrative being sold to the public is simple. Silver is rising because retail traders got excited, but that explanation is comfortable, easy to digest, and completely misleading. What's actually happening is far more serious. This is a physical demand crisis where the people who genuinely need silver are scrambling to secure supply, and the financial system is working overtime to keep attention pointed anywhere else. Here's the pattern observers have noticed. Every time silver begins behaving like it might break free from its traditional range, mainstream coverage becomes selective. Financial media talks endlessly about the same technology stocks. They focus on 7 companies as if they represent the entire economy. But the moment resource sectors, especially silver excavators, start positioning for a genuine rotation, silence, or worse. Dismissive headlines designed to shake out uncertain investors. And that should raise immediate questions. Because when the loudest voices in finance refuse to discuss something, it's rarely because that topic is unimportant. It's because it's inconvenient. So where is the real demand coming from? Not primarily from retail investors, though they play a role. Retail acts as the spark. What markets are witnessing now looks more like a producer and industrial scramble. The kind where supply cannot respond quickly. The kind where delivery constraints begin mattering more than opinions. And when markets tighten in this way, they tighten like a mechanism that doesn't loosen gradually. Industrial users need silver for manufacturing timelines. Producers are adjusting hedging strategies as costs rise, and both groups are discovering that available supply is not as flexible as assumed. This creates pressure, not theatrical pressure, but structural pressure, the kind that builds quietly until it doesn't. Now, here's where the excavator companies become critical. Mining equities serve as a gateway for broader public participation. When excavator stocks begin rising sharply, it creates contagion, it creates curiosity, it creates rotation out of overcrowded trades. And rotation is precisely what large institutional players do not want, at least not yet. Because a rotation into resource sectors doesn't just shift portfolios. It shifts psychology. When investors accumulate hard assets, they become less dependent on centralized financial systems. They require less permission. They become harder to direct. And in a structure built on financial dependence, independence represents disruption. So the question becomes, if the largest pools of capital benefit from keeping everyone crowded into a handful of mega-cap trades, why would they promote the sector pulling attention away from that concentration? They wouldn't. They'd do the opposite. They'd make excavator companies look boring, risky, irrelevant. They'd starve the sector of media coverage while quietly positioning themselves. And that's where BlackRock enters the picture. Most investors hear the phrase margin requirements increased and assume one thing: prices should fall. That's the textbook response because higher margins force leveraged speculators to cut positions. But silver, especially in a producer-driven demand environment, doesn't follow textbooks. It follows mechanics that most market participants never bother to understand. In futures markets, margin isn't just a cost for buyers. It's a cost for sellers too. The most consistent sellers are producers and institutions hedging their exposure. When margin requirements climb, it becomes more expensive to maintain those short hedges. So some of that selling pressure backs off. This is the margin paradox. What looks bearish on the surface becomes a stress test for supply-side participants. Silver supply doesn't respond quickly to price signals because a massive percentage is byproduct from mining copper, zinc, or gold. Even if prices spike, Supply doesn't just scale up. For primary silver deposits, the timeline for permitting and infrastructure is brutal. When industrial demand accelerates faster than supply can respond, price becomes the only mechanism left to balance the equation. Manufacturers, electronics companies, and solar producers need silver now. When now collides with not enough available, markets move in sharp, sudden stress bursts. This is the environment BlackRock is reading. Excavator companies pulling silver from the ground are about to become the most strategically important equity sector most investors are still ignoring. Here's a question that confuses most observers. If silver is strengthening, why aren't silver excavator stocks exploding already? The answer reveals how capital actually moves in financial markets, and it's not the way retail investors assume. The public is exhausted financially and psychologically. Over the past decade, most retail participants were trained to follow a specific playbook. Buy mega cap tech, buy the index, buy the safe basket, and ignore everything else. That training was deliberate and effective, so even when silver begins sending clear signals, the crowd remains stuck in old patterns. They're not looking at excavator companies or exploring resource sectors. They're still chasing what worked yesterday. Meanwhile, institutions don't move like retail. They move when they have to, and they move in carefully orchestrated phases. Phase 1 is reducing risk exposure and managing short positions. Phase 2 is rotating capital, quietly accumulating positions in sectors that benefit from the new market regime before the public narrative shifts. By Phase 3, when the media coverage arrives, their positioning is already complete. So, excavator stocks can lag early, not because they're broken, but because capital flows haven't fully rotated yet. And here's the critical insight most miss. Lagging is not the same as dead. Lagging can be the compression before the expansion, the coil before the spring. Because when excavators finally start moving, they rarely move politely. They gap higher and chain react across the sector. There's also a powerful valuation dynamic at work. When metal prices rise, an excavator company's margins don't just improve, they expand dramatically. Their operational costs for labor, equipment, and energy are relatively fixed. So a 20% increase in silver prices might translate to a 60 or even 80% increase in profit margins for efficient operators. That's incredible leverage. Yet the market doesn't price this in immediately. Why? Because attention is being deliberately managed elsewhere. Financial media promotes the same narratives repeatedly. AI, cloud computing, digital platforms. This isn't an accident. Attention is a weapon. When attention is steered towards specific sectors, capital follows. Resource sectors are decentralized, tangible, and harder to control through narrative alone. Silver, and the excavators that produce it, empower ownership outside traditional financial systems. That's uncomfortable for centralized structures. The incentive is to delay the rotation into resources as long as possible. Keep them boring, keep them ignored. But delays don't eliminate pressure. They accumulate it. And major players with access to flow data that most investors never see understand exactly when that pressure is approaching critical mass. They aren't waiting for confirmation. They're positioning before it. Because by the time excavator stocks make headlines, the easy money has already been made. And the rotation, when it fully ignites, won't wait for the comfortable crowd. Thanks for watching. Most portfolios today are built for continuation, not transformation. They assume the past decade will repeat. They assume the winners keep winning. They assume concentration equals safety. But concentration is not safety when the regime shifts. Concentration is fragility, and fragile positions break violently when structural conditions change. Here's what most investors miss about resource cycles. They don't start from strength, they start from neglect. Nobody builds supply when prices are low and narratives are negative. This creates a hidden deficit, a supply gap that doesn't show up in headlines until suddenly it shows up in price. Because silver isn't like software. You can't scale production with a server upgrade. You need geology, permits, financing, equipment, years. So when demand accelerates and supply can't respond, price becomes the only tool left to ration scarcity. BlackRock understands this pattern. They're positioning ahead of visible crisis. The easy phase is ending. The breakout phase is approaching. The $94 silver threshold isn't magic, but it represents a technical and psychological inflection point. BlackRock is betting on probability. They're allocating capital where structural tension is highest. Do you wait for confirmation and pay the premium? Or do you recognize the setup and position while it's still uncomfortable? Because comfort in markets like this is expensive.